Are we in the midst of seeing a financial crisis develop in real time right now by witnessing what's going on in the repo market? What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and recently, over the past couple of weeks, we've seen some very interesting, if not scary things start to happen in the repo market again. And so what we're going to look at in this video is, number one, brief overview of what is the repo market, how does it work? Number two, we're going to look at a history of some of the crises that have been preceded by things starting to show up, some signals that we've started to see before the crisis actually happens in the repo market, leading up to today, and the insane backwards problem that right now we're starting to see emerge in the repo market. Ready? Let's dive in. Okay, number one, what is the repo market? And for 99.9% of people, this is all you ever need to know about the repo market. Repo stands for repurchase, not repossess. It's not like those guys that go pick up the cars that the car loans haven't been paid on and haul them back to repossess them for the bank. The repo market is repurchase agreements. This is how financial institutions pay their bills. It is simply the marketplace that financial institutions go to swap cash for collateral. It'd be similar to you if you got close to the end of the month and you had already burned through your cash for the month. You had already spent your paycheck. You need more cash to make it through the end of the month. And let's say you own your house. So you go to somebody and you say, hey, I'll give you temporary ownership of my house. You give me the cash for the house, and then we agree, this is a repurchase agreement, we agree that in a couple of days, a couple of months, however long it is, I will repurchase the house from you, give you the cash back, plus whatever interest is charged, whatever interest rate is going on at the time. And this is how all financial institutions work. Very few financial institutions keep a ton of cash on hand to fund their daily operations. And usually financial institutions will be tapping the repo market in order to get their hands on enough cash that they need for their daily expenses. And there are a lot of other financial institutions that have the opposite. They have a lot of cash that they don't need. And so they're going out there and they are making those markets and they're making money on giving that cash out and accepting the collateral in return. That means that in the entire financial system, if you have more collateral and less cash, interest rates in the repo market are going to go up simply because there's a lot of people trying to borrow cash and not a lot of people with cash to lend out. And so the ones who do have cash to lend out are going to be able to charge a higher interest rate for it. This also means that when the opposite is true, when everybody in the financial system is flush with cash, those interest rates are going to drop because not a lot of people need to borrow cash right now. So that's what the repo market is, and that's how it operates. Number two, let's look at the history of the repo market. Everyone remembers what happened 12 years ago. Financial crisis, subprime mortgages, mortgage-backed securities, etc. You watched The Big Short, you know what happened. But what most don't know is that something happened in the repo market that signaled a crisis was coming, signaled something was wrong in the plumbing of the financial system. Repo rates spiked. Now, like I mentioned before, we know that financial institutions use the repo market to access cash for their funding. And how do they do that? They give collateral. Well, at that time, a lot of the collateral that was in the system was mortgage-backed securities. And for a while, most of the financial institutions, if they knew there was a problem, they just ignored it. They didn't want to be the ones to spark the avalanche, to signal that there was trouble with it. So if they knew about it, they just kept on playing the game. But once that avalanche started, not a single financial institution wanted to accept mortgage-backed securities as collateral. This was particularly a problem for institutions that pretty much only had mortgage-backed securities as collateral. This meant that if they wanted to offer that as collateral to get cash to fund themselves, then they would either need to pay a high interest rate, or no matter what the interest rate was, nobody would be willing to give them cash for that collateral. This left a few out in the cold, like Lehman Brothers. So here we have a relatively recent example of where the repo market signaled in advance that some big problem was going on in the financial system. There was no way for these institutions to access the cash once everybody realized that most of the collateral was bad and nobody wanted to accept the collateral anymore. Fast forward to September of 2019. This was the second time in recent years that the repo market kind of came into public eye a little bit. And the reason is because repo rates spiked yet again in September of 2019. So what happened in September 2019? Well, in a normal world, if a government wants to spend money in addition to the income it's receiving from taxes, they're going to borrow that. And in a normal world, when a government borrows money from their economy, it's not inflationary. It's not an expansion of the money supply. What they're doing is they're borrowing from these people or institutions, and then they're spending it over here. So there's no net increase of money in the system. It's just basically redistribution, and temporary at that because it'll have to get repaid. But essentially, you're just taking money from this area of the economy and redeploying it over here into this area of the economy. But what happens when the government wants to borrow more than the economy can lend? What happens if the financial institutions that buy these treasuries that lend the money to the government already are maxed out and they don't have the ability to take on any more treasuries onto their balance sheets? And what happens if this follows a few years of money actually in reserves getting sucked out of the system? Well, instantly you're going to have demand for cash go up. Financial institutions are flush with collateral, and this time it's not bad collateral, it's treasuries, but they need cash to fund their overnight expenses. And so if everybody is going and offering treasuries in the repo market as collateral and they need cash, but everybody's doing that and nobody has cash to offer, well, what's going to happen is the rates are going to spike until you get to a point where one or more financial institutions can afford then to offer cash in exchange for that collateral. And if there really isn't enough cash in the system, and no matter what rates go up to, there's nobody who has the ability to offer enough cash because everybody has too much collateral and not enough cash, what you have is a repeat of Lehman. And that's why that almost immediately the Federal Reserve stepped in September of 2019 to offer funding into the repo market. Hundreds of billions of dollars every single day injected into the repo market to make sure that financial institutions had the ability to get their hands on cash. So number 3, what is happening today? Because what's happening today is not the same problem that we've seen a couple times happen in the repo market before. Because for the last year and a half, we've seen an unprecedented amount of monetary expansion. And the mechanics are this. Number 1, government spends money. In order to fund that spending, they have to borrow. But when they go and try and borrow, the economy doesn't have enough cash to lend to the government everything that they want to borrow. And so the banks step in, the primary dealers, they lend some of it. So they're giving cash for a treasury. Now they're maxed out. And so they turn with that to the Federal Reserve and they say, hey, I'll change hands with you. I'll give you this treasury in exchange for cash. I'll just sell it to you. So the Federal Reserve says, absolutely. So the Federal Reserve gives the bank some reserves, takes that treasury off the hands of the bank. The bank now has reserves. They turn back around to the government. The government says, all right, let's repeat that process. So they just keep on going. The primary dealers, these banks, they just operate as the middleman in between the Federal Reserve printing money to fund or lend to the federal government for its expenses. And this repeats until government borrowing is satisfied. And you might think, well, government borrowing clearly is never going to be satisfied, but it can get satisfied temporarily. That's why for the last couple of months, we actually haven't seen that much of an increase in the national debt. Because last year during 2020, the federal government borrowed so much in excess of what they were able to spend that their checking account, it's called the Treasury General Account, got filled up to record levels. So this year they made it clear that they were going to intentionally bring that Treasury General Account back down to more normal levels. This has given them the capability to spend hundreds of billions of dollars in excess of the income that they're bringing in without actually increasing the amount that they're borrowing. They're just spending everything that they borrowed last year. This means that during 2021, for the last couple of months, most of the money that the government has been spending, which is money that is out of the system going into the economy, is not done by creating new treasuries, which right now financial institutions use as their collateral. That spending is just new cash entering the system. Now, many banks were very concerned about this, and I made a few videos about this because this was actually a problem. We spent the entire 2020 where lots of treasuries were entering the system, too much that the Federal Reserve, especially in the beginning, was having to pull those treasuries out of the financial system in order to make sure that the banks had enough cash on their hands. And they suspended the supplementary leverage ratio, which is the rule on how much collateral a bank needs to have for the amount of cash that they have as a liability. And so all the treasuries have been getting sucked out of the system by the Federal Reserve in order to make sure that the banks had the reserves that they needed. But the dynamics have completely reversed over the last couple of months. The federal government is draining the Treasury General Account, which is putting a ton of cash into the financial system. At the same time, at the end of March, the Federal Reserve did not extend the supplementary leverage ratio, reinstituting collateral requirements on the financial institutions. This means that all of a sudden banks were flush with cash, pushing the cash in the system to all-time highs, and collateral is nowhere to be seen, which has led to this really crazy dynamic where financial institutions are relying on reverse repo, where they're basically saying, hey, take my cash and give me some collateral. Take my cash and give me some treasuries at record amounts. In fact, just yesterday, we saw it hit almost 400 billion overnight. And keep in mind, yes, if you look at this chart, you can see that it's spiked above that before, a little bit above that before, but this was always at quarter or year end where you expect to see spikes like that come right back down. When you zoom in and look at what's been happening recently, it's been a quick spike, but it's a growing trend. It's not a 1 or a 2 day spike, which means that timing-wise, when everything should be business as usual, the amount that financial institutions are relying on reverse repos is at a record amount. So much so that the interest rates, the repo rates, actually went negative for some borrowers on some days recently. There was so much demand for collateral that people were saying, hey, take my cash, give me the treasury, and I will pay you to do that. So instead of what normally happens where you're paying to get cash, you're paying to get a treasury. Now, this is likely what has prompted the Federal Reserve to recently come out and say that they are considering setting up a permanent standing repo facility. This would, in essence, just permanently set up a facility that would be doing what they have been doing in the repo market just as kind of like an emergency measure. It would also broaden the amount of financial institutions that can access the Federal Reserve's money in the repo market. Now, essentially what this looks like is that the Federal Reserve is just one step at a time completely taking over the repo market. They don't want overnight funding rates to move. They will be there to provide the exact amount of cash as needed through the power of the printing press to anybody who needs it. No need anymore for those pesky price signals that the free market would send to signal whether something was wrong. Simply paper it over. Now, what is this going to lead to? Well, number one, keep in mind this dynamic that's happening right now is almost certainly temporary. The Fed knew in advance, because many people told them about it and many financial analysts were talking about it, they could see the amount of cash that was prepped to enter the system. The Federal Reserve and the Treasury, now led by Janet Yellen, who was the former chair of the Federal Reserve, are very close, coordinating with each other and working in conjunction with each other more than they ever have before. And so the Federal Reserve knew there was going to be a massive amount of cash injected into the system. They also knew far in advance that they were going to be ending the supplementary leverage ratio suspension that gave banks the ability to not care about how much collateral they had, which means they knew they were going to have to engage in record amounts of reverse repo because they knew how much collateral versus cash was in the system at the time and how much was going to be coming in. Further, like I said, this dynamic is temporary because a lot of it is caused by the federal government spending down that Treasury General account. A lot of cash is entering the system by the depletion of the Treasury General account versus the usual issuance of treasuries, which again is collateral for the banks. There's only about $400 to $500 billion to go in the Treasury General account before it reaches back down to the normal $400 billion or so that they indicated they wanted to get it back down to, which means that within the next couple of months, the Treasury issuance of new treasuries will probably shoot back up again to normal levels, which means that collateral will become abundant again in the system. And barring the unlikely event that the government reduces spending and engages in austerity and stops recklessly spending, they will have to start borrowing again in order to fund it. And this is the reason why the Federal Reserve likely wants to make the standing repo facility, because they know that in the system right now, the dynamic where the financial system is flush with cash and is desperately needing collateral is temporary. And within a couple of months, this trend will likely reverse. And after the financial system spending months of dumping cash to get collateral, we're going to once again be in a system where collateral becomes abundant and everybody's scrambling for cash again. And the Federal Reserve, the last thing they want is for a broad range of financial institutions to be in this problem. They can already deal with the primary dealers and the banks, but they want to broaden this out to make sure that if some of the other financial institutions don't have some of the foresight, that they have access when they need it to access the Federal Reserve's funding into the repo market. The last thing they want is another Lehman Brothers or September of 2019 event to happen again. They want to be ready to offer either unlimited cash or unlimited collateral as needed to whoever it's needed. So what's the conclusion? Well, if you can't see it by now, monkeying around with complex systems, especially one like the financial system, always breaks things. These people are what Nassim Taleb calls interventionistas. If you try and stop one thing from getting a little worse over here, you end up breaking something over here. And then when you turn your attention to that to try and intervene a little bit more to fix that or stop that from breaking, you end up breaking 2 or 3 things over here. This is what F.A. Hayek calls the road to serfdom. Every step towards socialism, towards central decision making over an economy, necessitates. It is necessarily a step towards totalitarian control over the system. And as you do that, and it tends towards top-down control, especially at the scale in which the financial system operates, the magnitude, you have unintended second and third order effects that are almost guaranteed to be disastrous. And you know, one of the likely reasons that this is happening right now is because some of you haven't hit that subscribe button yet. And the more people that learn about this and understand what's actually going on behind the curtains at the ivory tower by the interventionistas, the better things will be. Because the more you know, the more control you have over your own financial destiny. So do the world a favor. Hit that subscribe button so that this channel can grow and more people can find out about what's really going on and understand how to protect their money and wealth. As always, I really appreciate you guys. Thanks so much for watching. Have a good day.